Okay, ladies and gentlemen, I'm very happy to welcome you to the first edition of the International Basel IV channel. I hope all of you had no problems to dial in and that you have no technical problems and that you can see actually the presentation. Before we start with our presentation, please give me the possibility to, wait, we have to switch off slides, yeah. To give me the possibility to introduce myself. My name is Neisen. I'm partner in PwC here in Germany, and I'm leading the regulatory management practice here in Germany. Apart from that, I'm also leading the global Basel IV initiative of Basel IV. Next to me is my co-speaker, Abdellah. Maybe he can introduce himself.
Yes, good afternoon all from all different countries. We're very excited and very happy that so many people are joining this session. And we're excited about starting this series of webcasts or webinars. My name is Abdellah. I work in the Netherlands, today joining Martin here in Frankfurt. I focus on advising, helping banks around prudential regulation and related financial reporting topics, particularly on financial instruments. And I'm helping Martin in our global Basel IV initiative and leading that as well in the Netherlands.
Yeah, thank you very much, Abdellah. Before we now actually start and go into detail into the introduction of Basel IV, please give me the possibility also to say some words about this new concept, the Basel IV channel. What is the meaning behind it? What do we plan for the future? I mean, we thought, how can we actually inform our clients about the latest developments of the Basel Committee, because there were quite a number of publications in the last month. And we came up, of course, with the idea of sending a newsletter, but both alternatives, sending a newsletter by post or sending a newsletter via email, was not the best thing, we thought, because probably it ends up in the trash can or in the spam filter of your email account. So we decided to go a little bit a more modern way and invented this Basel IV channel, which is a webinar. We plan to do this Basel IV channel every 4 weeks and give you the latest information about what is happening in Basel, and also to go a little bit more into detail each time for a certain topic. For example, today we will give you more a broad overview, what we consider as Basel IV and what the biggest challenges are, but we have already planned the next Basel IV channels that will deal more about the standardized approach for credit risk and the new standardized approach for market risk. Yeah, as you can see, this is our agenda, and the agenda is quite full. So in the first step, we will give you a little overview how we define Basel IV, because actually Basel IV is not an official name that was given by the Basel Committee. We will come back to that later. And we will focus mainly on the proposals coming from the Basel Committee for Pillar 1. And there we make no differentiation between their proposals for the standardized approaches or for the internal models. We cover both. And also we have as a big topic the new Pillar 3 disclosure requirements. Currently we are not focusing on Pillar 2 developments because, cross fingers, luckily the Basel Committee was not publishing anything on that. I mean, the ECB is doing so, of course, but Basel not yet. Okay, I just mentioned it. Basel IV, the term, is not an official term, but nevertheless, there were quite a huge number of publications from the Basel Committee proposing new approaches on how to calculate risk-weighted assets. And some of these papers are already finalized, other papers are still in the consultation phase. And there was always also one member of the Basel Committee, and he insisted on this citation that I have here on the slide, that a framework called Basel IV is not known to the Basel Committee. So after him, we had to speak about actually Basel IV topics, and we had the problem how to name it. And in the end, we said, okay, we do it like Harry Potter, and we call it the standard that must not be named. Yeah, so you can see a very famous person here from the Harry Potter movies. Okay, coming back to the content, what is Basel IV about, at least how we unofficially define it? It's mostly everything that is about calculating risk-weighted assets. If we remember what was Basel III about, the focus of Basel III was mostly own funds. Of course, there was also a little bit of liquidity, and there was also a leverage ratio that was introduced, but the main focus was on the definition of regulatory capital, the new capital ratios, capital buffers, deduction position. There was the big impact for the banks. And Basel IV now turns it off on the other side completely, focusing only on risk-weighted assets. And you can say many, many things about the Basel Committee, but not that it's an unfair committee, that they have a favorite type of risk, and that's why they change all approaches for all types of risks. So no matter if we are talking about capital requirements for credit risk, for securitization positions, for counterparty credit risk, market risk, operational risk, CBA risk, or even the new type of risk, step-in risk, the Basel Committee is proposing new approaches on how to calculate capital requirements for these types of risks. Apart from that, there will be also a big change in the Pillar 3 disclosures, and if you look to the certain papers that were published by the Basel Committee, some of them are even already finalized. So if we talk, for example, about the new standardized approach for counterparty credit risk, it is finalized. The fundamental review of the trading book is finalized since January. So Basel IV is not something vague that will come one day in the future. It is something that will come. The only question is if in 2 years or in 3 years. Yeah. So the first topic we would like to talk a little bit more in detail is the new standardized approach, and that will be my colleague Abdellah. Thank you.
Thank you a lot, Martin, for the introduction. I think it's very good to indeed understand that the changes are significant. There are many regulatory changes. It's quite a tsunami, but we are approaching those changes very fast. And one of the I would say maybe one of the significant one is the revised standardized approach for the credit risk in Basel IV, what we call Basel IV. To start maybe with the Basel IV objectives and the task force of the Basel Committee that was tasked with basically looking at the RWA comparability, because if we look at the comparability of RWAs between banks, there is quite some differences, complexity, and also transparency is very important. In this regard, in terms of the standardized approach for credit risk, there are quite some weaknesses in the current standardized approach. Just to mention a couple, the mechanistic reliance on external ratings has been highly commented on. The calibration basically is quite outdated. It stems from many years ago, and also it doesn't capture most important risk drivers. So there is insufficient risk sensitivity. And a fourth point, which is also, of course, relevant, is a difference between territories and what we call then the national discretions, where there are differences in application of risk weights. The first consultation paper focused highly on elimination of the use of external credit ratings, and however the comments were very significant because there were some risk drivers which were very much questioned by the industry. One of which, if we look at real estate or residential real estate exposure, where one of the risk drivers was the debt service coverage ratio, which is of course a very perhaps old risk driver. And then for corporates, looking at leverage and looking at revenue, and of course if we look at revenue, the accounting or the GAAP, the accounting standard determines the revenue. So you may well end up with a same corporate applying different accounting rules and then ending up with a different risk weight. So a lot of comments about the use of certain risk drivers. So the Basel Committee went back, reviewed basically their new approach, and came up with reintroduced the use of external ratings However, in combination with the use of certain risk factors. And maybe to go to, without going into a lot of details, our next session will be about the standardized approach on credit risk, but maybe to mention some of the key challenges and key impacts that we see will increase the capital requirements. We see quite some, we expect quite some increase in specialized lending. We see, as said before, in real estate exposure. For example, under the current standards, the high LTVs, so exposures with high LTVs, will still be able to be assigned a low risk weight for part of the exposure, whilst under the revised approach, you have to look at the full exposure. If we look in certain territories where there are high LTVs, and to mention a territory where I'm situated in the Netherlands, where we have high LTVs, you will suddenly end up in very high risk weights compared to the risk weights we use now for up to 80%. We use 35% risk weight. So those are some of the very key and important challenges that we see, and that will increase the capital requirement RWAs for credit risk.
Yeah, thank you very much, Abdellah. Let's go to the next topic, that is the new standardized approach for the counterparty credit risk, which belongs also to the family of new approaches for credit risk. But here it's a little bit different. We are not focusing on the calculation of risk-weighted assets or of risk weights. We are more focusing on the calculation of the exposure, and therefore a specific type of exposure. We are talking here about the product family of derivatives. Currently, there are three methods to calculate the exposure for derivatives. It's the current exposure method that is mostly used by most of the banks. We have a standardized method that is almost not used by any bank. And last but not least, we have an internal model method that is only used by very large internationally active banks, and it's a highly sophisticated approach. And the first two approaches, the current exposure method and the standardized method, will be replaced by the new SA-CCR, or how the supervisor call it, the SA-CCR approach. And therefore, this approach will be relevant for all banks, because from the smallest banks that have only retail business and very, very few derivatives, they have to use it, and also large internationally active banks have to use these approach because they will have to calculate their capital floors based on the SA-CCR. If you look to the general formula, how to calculate the exposure default for derivatives in the future, you see many similarities to the current exposure method. You have also replacement costs. You have an add-on. Yeah, those of you that know the current exposure method will directly recognize that, but we will also have in the future a multiplier for the add-on, and this multiplier will account for the effect of over-collateralization and also of negative market values of derivatives in one netting set. And apart from that, we have one supervisory factor, an alpha factor, that is the same one as in the internal model method, which is 1.4, which is nothing else than an additional conservative haircut or add-on on the overall exposure that is calculated with the new SA-CCR approach. Altogether, the EAD is calculated for each netting set, and netting set means for each counterparty, and we are not talking about a group of counterparties. So we are talking here about legal entities where you have one netting agreement with, and also the EAD will be always lower when you have a margin agreement than if you have no margin agreement, of course. The SA-CCR approach is also a quite complicated approach, especially if you compare it to the current exposure method. Therefore, in one of our future editions, I'm really sure that we will go much more into detail about the SA-CCR approach.
Yeah, well, I think we talk now about some standardized approaches, and of course we also have some IRB approaches for credit risk. Basically what the Basel Committee did, they performed a review and assessment back in 2013, where they looked at internal models and what the internal models produce in terms of RWAs. And they basically found that there is quite some difference between similar exposures applying models of different banks. So basically banks will come up with different outcomes for the same type of exposure. So they basically assessed the reasons for the difference, and the difference was mainly in high risk exposures. The difference was let's say little, and the risk weights were consistent. But with low default exposure, or low default exposures as we call them, the difference was inconsistent and was basically significant. And those low default exposures, including banks, other financial institutions, and large corporates, the Basel Committee basically concludes that the lack of sufficient reliable data to determine reliable parameters, or availability of data to determine reliably key parameters in the internal models, including PDs, LGDs, EADs, and related credit conversion factors, were basically the main drivers of the differences. So they decided to basically eliminate the use of internal models, the IRB approach, for banks, other financial institutions, and for large corporates. In addition, they also suggest to eliminate the use of IRB approaches to equity exposures. Is basically for two reasons. One is they basically conclude we can't explain why there are differences between the banks, because the banks will probably not have more data than other banks to be able to calculate different outcome. And secondly, the equity exposures, listed equity exposures, will be in the trading book, so it will only be the non-listed equity exposures, which are relatively few, so private equity type of exposure. So basically, on the one hand, there are not many equity exposures, is the conclusion. On the other hand, we can't explain the differences, so we eliminate also the IRB approach for equities. And on top of that, they also basically set some, or they specify some estimation practices for certain key parameters, and they introduce certain floors to PDs, LGDs. And the key parameters, in addition to credit conversion factors, are of course also maturities. In terms of maybe one other point included there is some ambiguity about the simple thing of defining what a commitment is, because that of course drives quite some capital requirement for certain banks for off-balance sheet exposures. So basically, this is in summary what this very recent proposal has set out. And very recent is, I think, a week ago.
Yeah, it was just published last Friday. And we made the first test calculation only for giving you a flavor how big the impact will be to shut down the IRB approach for certain portfolios. We made a test calculation for a large corporate here in Germany. It's Volkswagen, VW. And based on internal parameters that we have observed at our clients, they receive currently a risk weight that is between 40 and 45%. And when really the IRB approach will be not allowed anymore for these kind of large corporates, the risk weights will go up to 100% because the external rating is not the best one. So it will definitely have a huge impact for banks. Yeah, next topic is securitization, certainly in the focus of the supervisor since the financial crisis, of course, and we have seen already changes very close to the financial crisis was called Basel 2.5, especially there the risk weights were raised a little bit, and special risk weights, higher risk weights for resecuritization positions were introduced. But of course, it was not the end. Therefore, the Basel Committee has developed completely new approaches for securitization positions with the goal, first, to reduce the reliance on external ratings, similar to the normal standardized approach for credit risk. Of course, they want to increase the risk sensitivity. That is very important. They want to consider additional factors like maturity, where the position is in the waterfall, the thickness of the tranche, and so on and so forth. Also, they want to introduce the cliff effects, especially in the current standardized approach. You have a jump for certain rating external ratings from 350% to 1,250, and that it's really a huge step. And then, of course, for certain positions with very, very good rating, mostly AAA rating, the Basel Committee thought that the risk weights are too low, so they increased the risk weights there, and they're strangely on the other side, where you have certain securitization positions with low ratings. They want to reduce the risk weights because they say they were overproportionally too high. Currently, we have a standardized approach and an IRB approach and an internal assessment approach for securitization positions. In the future, we will have 3 completely new approaches. It's one IRB approach called SAC-CCR, which is basically a more or less simplified supervisory formula approach that we know already right now, where the input parameters are PDs, LGDs, and capital requirements under IRB. But it's not so much simplified, I must say. It's only some little parameters are changed. If banks are not able to use the SAC-CCR approach, they can fall back to external ratings. This SAC-CCR or external rating-based approach is more or less the same IRB approach with external ratings that we see already right now, only the steps between the risk weights are much smaller, so we have more diversity of the risk weights, and also some additional risk parameters like maturity and thickness of the tranche are considered. Apart from that, there will be also a standardized approach that can be used if there is no external rating available and also no IRB data. There, the Basel Committee proposed also to use a kind of supervisory formula that we see right now, but of course the input factors will be not PD and LGD, it will be standardized approach risk weights. And last but not least, if everything fails and the bank has not sufficient data to use these 3 approaches, there is always the possibility of capital deduction or a risk weight of 1,250%. The big impact for the banks here, if they still hold securitization position, is that if you want to use these new approaches, you really need a lot more data, and especially if you're an IRB bank, you need a lot of internal data for the underlying securitization portfolios.
Yeah, so I think then we go to another very, one of the 2 most significant topics, being the revision of the market risk framework, or what's known as the fundamental review of the trading book. And this is basically, during the financial crisis, some key concerns around market risk were basically on field. So the Basel Committee started with the first consultative document already in 2012. And just finalized the directive, although we do understand that there are still some discussions, some big banks discussing with the Basel Committee. Having said that, basically the key weaknesses that are basically found in the current framework are around the boundary between the banking book and the trading book, because of course that drives the capital requirement and the approach that is being used, or the framework that is applicable. Second one is around the weakness of the current FAR model, which is used in the current market risk framework. Another important one is about the liquidity horizon, which of course we've seen during the credit crisis that quite some markets became illiquid, and they become illiquid for longer periods, and resulting in the framework not capturing the full loss. So basically, what did the Basel Committee do in terms of these key changes or key weaknesses, and what are the key changes? Basically, went and started trying to clearly define the cutoff between the banking book and the trading book, so defining the boundary between the 2. Of course, under the current framework, there is a, let's say, definition of a trading book, but that's quite principally based. What the current or the revised framework does, it basically gives a definition, but it also gives some presumptions around what should be in a banking book, or what would be expected in the trading book. Giving examples around if something is for accounting held for trading, then obviously it should be in the trading book. Significant part of derivatives, or maybe you could say almost all derivatives, would then also be in the trading book. Although there is quite maybe some small inconsistency about held for trading and derivatives. We'll get into those details later on. Then around some additional tools for the for supervision or for supervisors around defining banking book and trading book, where the bank has to clearly and be able to explain why something is in the banking book and why in the trading book, where we've seen in the past, especially in some jurisdictions, that there was basically little discussion about the boundary between banking book and trading book. So secondly, to increase basically risk sensitivity, there's also a new standardized approach for calculating RWA. Some may argue that it becomes quite complex for a standardized approach, but if a bank falls or has a trading book, trading book's exposures will have to apply one of the approaches, either the new standardized approach or the revised internal model method or internal model approach. What is the change in the internal model approach? Most important change is the use of the so-called expected shortfall instead of the FAR approach, which basically means the expected shortfall captures the so-called tail risk, which is not captured in, of course, the FAR approach. What are, in addition, key changes are around quite strict approval process around the use of models, and based on a desk by desk. So it could well be that certain desks use internal models and others are not allowed to use internal models. And in addition, the internal model approach is, or the outcome is floored at the standardized approach method, which basically means the key or most significant challenge for banks using the internal model, meaning using internal model approach, using standardized approach, and in addition to that, in terms of backtesting, they will have to still use the FAR framework to backtest, because the backtesting of the expected shortfall will not be possible. In terms of so most important for the big banks, but also for the smaller banks, which may well end up with banking books, will have to do quite some complex calculation. And the increasing capital requirements that we are seeing in test calculations, especially for internal models, are 4 or 5 times current capital requirements. So there is quite a big increase in capital requirements for market risk.
Thank you, Abdellah. Now we come to the CVA framework, which is quite a funny thing, because the CVA risk capital charge was introduced with a Basel III framework, so not so long ago. Actually, here in Europe, it was introduced on the 1st of January 2014, and now we have April 2016. So it did not take long for the Basel Committee to develop something new. But of course, the Basel Committee had some reasons. First, the current CVA framework does not cover really 100% all the risks of CVA, especially the risk of the underlying. Currently, mostly only the changes in the creditworthiness of the counterparty is considered, and also there are some shortfalls in the recognition of CVA hedges. Then, of course, the CVA risk capital charge that we have right now has nothing to do with the CVA that is calculated under accounting rules. So they wanted to align these two frameworks a little bit. And last but not least, as we just heard, there is a new framework for the calculation of capital requirements for market risk, and they also want to align these two frameworks, market risk and CVA. Therefore, of course, we have two big approaches in the new CVA framework, one FRTB, or Fundamental Review of the Trading Book CVA framework, and one basic CVA framework. The FRTB CVA framework is more or less the same approach as for the standardized approach for market risk. Therefore, it's based on sensitivities, but not on interest rates or equity prices. It's on the calculated based on the sensitivities of CVAs. And the Basel Committee actually planned to divide the CVA framework of another fundamental review of the trading book into an internal model approach and a standardized approach. But since last week, Friday, we know that the Basel Committee does not allow the internal model approach anymore for the calculation of CVA risk capital charge. So we only have a standardized approach that is based on the fundamental review of the trading book. Last but not least, there's one basic CVA approach for the banks that are not able to calculate the sensitivities or have simply so few derivatives and that they cannot do it. This basic CVA approach is more or less from the concept the same one as we have now in the standardized approach, but of course also the shortfalls of the current framework were addressed, especially like the underlying risks and also the better recognition of the CVA hedges. Therefore the formula looks similar but has some important changes.
So now I think we focused on credit risk and market risk predominantly. Of course, the third risk class in the Basel framework is operational risk, which is also a very important one. So the current framework basically sets out, in general, three approaches: the basic indicator approach, standardized approach, and the advanced measurement approach. The first consultative paper that was prepared was basically about revising the standardized approach, and then the second consultation paper focused on one single approach for all banks. This single approach is basically a combination of the standardized approach and the advanced measurement approach. To start with, where we see these business indicators is basically comparable with the current standardized approach, where we basically take different profit and loss components and we divide those into, or group those into, interest, lease, dividend, income component, services component, and a financial component. And based on the distinction into those components, we determine the outcome of the business indicator, and the business indicator then we group into buckets and apply basically a ratio to, as you can see on the slide. What is and this is basically comparable to what we do currently under the standardized approach, although there are quite some difficulties in determining the different components. What is services component, what is interest, lease, and the dividend component, especially also again when you look at the differences in different accounting standards. So on top of that, also for, as I said, it's a combination of the current standardized approach and the advanced measurement approach. On top of determining this, the business indicator component, there is also a multiplier which is driven by an internal loss component, which basically means internal losses have to be monitored and determined what the impact is on the business indicator component. Either will increase, so it will increase then the capital requirement, or decrease the capital requirement, although floored at 0.5. What does this mean? If a bank is, for example, on the average loss in the industry, the multiplier most likely will be around 1. If the losses are above industry, they most likely will be above 1. What do we see here also in terms of impact assessment, especially for the current advanced measurement approach? Banks increase in capital requirements, specifically by this multiplier that I just explained. Also, if we look now at the current losses in practice, and the internal losses have to be captured under this framework for 10 years. The current add-on for conduct risk, and we've seen quite some losses in practice, will result in high multipliers and ultimately in significant increase in capital requirements for advanced measurement approach banks, but also we expect the same for the capital requirements for, let's say, the current standardized approach banks.
Yeah, thank you very much. I mean, we performed already some test calculations for operational risk, and we see banks that are currently using the advanced measurement approach and have to fall back on this new standardized method. They at least will have an increase in the capital requirements of 2 or 3 times higher. And even if they have to consider a higher loss multiplier, they even end up in 5 times or 6 times higher capital requirements. I mean, operational risk was never the biggest part in the risk-weighted assets, but if you are in the future calculating with 6 times higher capital requirements, it becomes quite relevant, definitely. Yeah, last but not least, last topic for the Pillar 1 are the capital floors. I mean, as you heard already several times, the focus of the Basel Committee is more and more on standardized approaches. and not so much on internal models anymore. And that you can see also here, because the Basel Committee has the idea to introduce new capital floors. I mean, we have already one capital floor right now, which is the Basel I capital floor, but that capital floor is mostly not relevant for most of the banks that are using internal models. How you can interpret such a capital floor, it's nothing else than just a minimum risk weight for banks that are using internal models, no matter if it's for credit risk, market risk, or operational risk is not relevant anymore because they anyway shut down the advanced measurement approach. What are the reasons of the Basel Committee to introduce such capital floors? Of course, when you develop a model, it's very individual and it's individual bank per bank, so it's difficult to compare actually the result of these internal models, and therefore they want to introduce these capital floors. But also, of course, when you develop an internal model, it's quite difficult. You must be sophisticated, but nevertheless there can be mistakes in the modeling, so there's always an inherent model risk, and the Basel Committee seeks to cover that model risk also with these capital floors. And then, I mean, I never have seen a bank like that, but I heard about banks that were using internal models and were improving them only with the goal of calculating lower capital requirements. Of course, in Germany, I've not seen any. Abdellah, I think in the Netherlands also never seen it. Must be other countries. But of course, the Basel Committee wants to reduce also here the possibility to tune simply your risk-weighted assets by changing internal models. And last but not least, the approval process for internal models is different in each country. And also the quality of these approval processes were very different. So here they want to cover the risk of these different approval processes also with these capital floors. I mean, here in the EU or in the Eurozone, at least, the ECB is planning an internal model review, which means all the 7,000 internal models that have an approval currently of the supervisors will get a reapproval. So there will be a huge new approval process in the upcoming 2 or 3 years conducted by the ECB. How can a capital floor look like now? There are two proposals from the Basel Committee. One is an overall capital floor that covers operational risk, market risk, and credit risk, and the other one is that there are each capital floors for each risk type, one for credit risk, one for market risk, one for operational risk. But the Basel Committee says that they maybe even want to make it more detailed, and since the publication of last Friday, we see that they will have already some additional floors for the risk parameters in the IRB approach. That's also consistent with the proposals of the Basel Committee for the capital floors. If there will be some additional portfolio-based capital floors also for IRB portfolios, that the time must see, and I'm sure the Basel Committee wants to perform first some additional test calculations on that before he introduces more.
Yeah, and I think to tap it off with the Pillar 3 changes, we focus, of course, on the Pillar 1 changes, Pillar 3 changes around disclosures. We've seen some or the changes or proposed changes already last year, but just recently there was an update to those changes. To summarize the big changes, what basically is included, other than, of course, new subjects which are required to be disclosed. For example, on TLAC for the significant banks, but also an overview of key matrices which have to be reported frequently. But most important, I think, in terms as well in terms of workload, is the fact that in the past we didn't have any fixed formats for templates. So now there are templates with fixed formats which have to be completed as they are. Some are flexible, but there are also fixed ones. Even if parts of it are not applicable, you still have to complete, of course, the template. The second most important change is around frequency. In the past, of course, and currently Pillar 3 disclosures are disclosed, published annually, so once a year. But under these revised requirements, it requires certain topics, certain disclosures to be published either semi-annually or even quarterly, which means compared to the current way of working, quite a change for banks. In addition to that, there is also a significant increase in qualitative disclosures compared to the quantitative changes. And on top, to top all the changes and all the challenges up is the fact that it's expected that the Pillar 3 disclosures are published together with the disclosure of the financial statements. And of course, that's basically a rule we know under the current standard, especially in Europe under the capital requirements regulation. But of course, with increased level of disclosures, it will give even more challenges because, of course, the departments that prepare disclosures for the financial statements will also be involved in preparing disclosures for Pillar 3 reports. So that's, I think, we close off Pillar 3.
Yeah, thank you very much, Abdellah. I mean, at this stage, it's also worth to say something about the timing of the proposed changes. There are different points of time that the Basel Committee is currently proposing when new approaches come into force. For example, the SA-CCR, the SA-CCR approach for derivatives, they suggested that it comes into force on the 1st of January 2017. They now postponed it to the 1st of January 2018. The fundamental review of the trading book is expected to come into force in the end of 2019. My personal opinion is that we will see the trend that they will postpone each of the new approaches to the end of 2019, when also the fundamental review of the trading book must be applied for the first time, and that there will be again a big bang like the same as we have seen with Basel II and Basel III. It's not official, of course, and it's my personal opinion, but I think that's the only thing that makes sense. If not, you have each year changes, and to include that into your capital plans and to explain that to your investors might be very, very difficult. So the reason why I say that is that I currently think that the new Pillar 3 disclosure requirements are the only new requirements that maybe come into force already earlier. Officially already on the 31st of December 2016, so the next date for disclosure, but I don't think that the Basel Committee and the European Union is fast enough, but at latest in the end of 2017 we might see already the first disclosure reports that follow this new scheme with fixed templates, with a higher frequency, and with a lot of more content. Yeah, that's it regarding the introduction into Basel IV. I hope you enjoyed our first edition. We are very keen on your feedback. So if you want to send us your feedback, please send it to our email addresses. If you have any questions regarding the content, of course, you can contact us as well, but also we have included here the contact details also of your local Basel IV expert. These contacts are also downloadable from the registration page for the Basel IV channel, so you can always go back also to your local contacts. And I would like to say that the next Basel IV channel edition will be in May, probably in the first week of May, and it will be about the new standardized approach for credit risk. And then the next edition after that will be in June about the new standardized approach for market risk, like one of the most important parts of the fundamental review of the trading book. For those of you who received for the first time the invitation for the Basel IV channel, please consider that you can always forward your invitation to other colleagues. So if somebody else is interested in participating in this Basel IV channel, please forward just the mail. Everybody is free to register. The whole Basel IV channel is free, and we are happy when we get more and more participants. Currently, we have in this Basel IV channel more than 200 participants from all over Europe. We even have some participants from the United States and from Australia, so I'm very happy that we are broadcasted all over the world. But of course, I will be much more happy when the next edition we will have more than 500 participants. So please spread the news, and if you have any feedback for us, please give it to us. For those of you who are not able to attend always to the Basel IV channel, we will put the recorded sessions always on YouTube. There will be a PwC Basel IV channel. You can currently find the German version already inside that YouTube channel, and we will put this recorded session in the beginning of next week also in the YouTube session, for that you can always look at it if you have further questions, or if you want to listen to one topic again, or simply if you have one workmate or one colleague that wants to listen to it as well. So thank you very much from my side again. Abdellah.
And from my side, thanks a lot for joining. I hope you enjoyed this session, and that you are, like us, looking forward to the next session.
Yeah, and be aware, everything that we just explained about Basel IV is not an April 1st fool's joke. It really comes. So thank you very much. If you have any questions, do not hesitate to contact us. Thank you very much. Bye-bye.